EU diversifies partners, looks to internal market to counter potential 144 billion euros loss. Could these strategies safeguard Europe's supply chains and global standing against pressure from Washington? In 2023, the European Union was the world's largest trading power, accounting for 16.1% of global trade, valued at 7.6 trillion euros, according to Eurostat 2024. The US remains the EU's largest trade partner, representing 17% of EU trade, equating to 1.6 trillion euros. However, this trade relationship lacks any free trade agreement, FTA protection. Under former President Donald Trump, the US imposed tariffs of up to 25% on imported cars from the EU and 10% across the board. Alarmingly, Trump's trade advisors are suggesting a return of a 20% tariff on all EU goods within the first 3 months if he re-enters the White House, according to Bloomberg. According to the European Commission, a retaliatory tariff war at 25% could reduce EU exports to the US by 17.5%, causing a direct loss of 0.54% of the EU's GDP, which is equivalent to 144 billion euros, according to a European Commission trade impact study. US consumers would face sharp price increases on imported goods from Europe, including cars, wine, and industrial equipment. The Brookings Institution predicts core inflation could rise by an additional 0.3 percentage points if these tariffs are reinstated, according to Brookings. To reduce dependency on the US, the EU is accelerating FTA negotiations with emerging economies. India is a top priority. If an FTA is concluded, the import tariff on cars could drop from over 100% to just 10%, according to Reuters. Bilateral trade between the EU and India is projected to reach 167 billion euros by 2026, with EU exports totaling 75 billion euros and imports from India reaching 93 billion euros. Additionally, a deal with Mercosur, Brazil, Argentina, Paraguay, and Uruguay could boost total trade to 126 billion euros, with the EU exporting 77 billion euros and importing 49 billion euros. For Mexico, improving market access alone could increase EU exports by 20%, or 10 billion euros. In total, if all 3 FTAs are approved before 2026, the EU could recover around 91 billion euros, though it would still fall 53 billion euros short of the losses from the US. Alongside expanding partnerships, the European Commission is calling for improvements to the EU's single market, established in 1993. While barriers to goods have been removed, 3 key pillars, services, capital, and labor, still face significant hurdles due to national laws. For example, Polish plumbers must recertify to practice in Belgium. Startups in Portugal struggle to raise funds from the Netherlands due to differing investment laws. And EU citizens face bureaucratic obstacles when working in other member states. According to a new study by the European Parliament, this lack of integration costs the EU 1.1 trillion euros annually, 279 billion euros from services, 415 billion euros from the digital market, 300 billion euros from goods, and 50 billion euros from public procurement, according to European Parliament policy study. If reforms are implemented, the EU could fully recover the 144 billion euros loss from US tariffs, while also boosting its internal competitiveness. The United States has just imposed a 20% tariff on goods from the European Union, while the United Kingdom faces a lower rate of 10%. This raises the question: why is Northern Ireland, once regarded as stable after Brexit, now at the center of this latest trade tension? On April 9, 2025, President Donald Trump announced a new wave of import tariffs, targeting nearly all of the United States' trade partners, referring to the move as Liberation Day. In this announcement, the European Union, EU, faces significantly increased costs, with a 20% tariff applied to all goods exported to the US, totaling over $500 billion in 2024. In contrast, the United Kingdom is subject to a lower rate of just 10%, with an export value of around 78 billion US dollars, clearly gaining a distinct advantage. The discrepancy in tariff rates between the EU and the UK creates an imbalance in the competitiveness of European countries within the US market, particularly in sectors such as pharmaceuticals, where EU exports reached $104 billion, along with premium consumer goods and technology. This also partly reflects President Trump's strategy of differentiation, as he has consistently emphasized close ties with the UK as it remains within the EU's customs union and single market under the Northern Ireland Plus Protocol, which is part of the Brexit agreement. This intermediary position makes Northern Ireland especially vulnerable to disruptions arising from international trade conflicts. Should the Plus EU formally implement retaliatory tariffs, goods arriving from the Plus United Plus states into Northern Ireland would be required to comply with stricter regulations and customs inspections, adding an average of +2 to +5 days in clearance time, and increasing logistics costs by +8 to +12%. According to a report by the Plus London Plus Institute for Plus Trade Plus Policy. This means that the EU's retaliatory tariffs against the Plus United Plus states could, in effect, be enforced within Plus Northern Plus Ireland, beyond economic consequences. The issue also carries political implications, particularly for the Plus Unionist community in Northern Ireland, where more than plus 44% of the population supports maintaining the Union with plus Great Plus Britain, and where there is ongoing concern about being separated from the rest of the Plus United Plus Kingdom. Under the Plus Windsor Plus framework, signed in the Plus March 2023 between the Plus United Plus Kingdom and the Plus European Plus Union, goods entering Plus Northern Plus Ireland are divided into 2 lanes. Plus Green Lane applied to goods intended solely for domestic consumption within Plus Northern Plus Ireland, exempt from customs checks. Plus Red Lane applied to goods that may enter the Plus EU market via the Plus Republic of Plus Ireland, subject to mandatory checks and compliance with Plus EU standards. This lane-based system now faces the risk of disruption if trade tensions between the Plus United States and the Plus European Plus Union continue to escalate. If the Plus EU imposes retaliatory tariffs on the Plus United States through Plus Trade Plus Defense Plus instruments, then under Plus Article 7.2.2 of the Plus Windsor Plus framework, all affected goods would be automatically redirected to the Plus Red Lane. According to estimates from the Plus EU minus UK Plus Joint Plus Committee, approximately 17% of Plus US imports into Plus Northern Plus Ireland in 2024, valued at more than £1.1 billion, could be impacted. All goods from the Plus United States entering Northern Plus Ireland would be subject to strict customs checks, even if there is no intention for those goods to enter the Plus EU. During a questioning session in the Plus UK Plus Parliament last week, Gavin B. Robinson, leader of the Plus Democratic Unionist Plus Party, Plus UP, publicly expressed concern over the potential impact of the Plus EU's retaliatory tariffs on the region. He emphasized that while Plus Northern Plus Ireland remains a part of the Plus United Plus Kingdom, import regulations could still be influenced by the Plus European Plus Union if retaliatory measures were to be implemented. The disruption of internal trade caused by Plus EU policies, even though Plus Northern Plus Ireland is constitutionally part of the Plus UK, could have a negative effect on the confidence of the Plus Unionist community, which has already experienced significant strain following Plus Brexit. The United States has recently imposed a 10% tariff on goods imported from the United Kingdom, presenting significant challenges to the British economy. However, Could this development also present a potential opportunity for the UK to thrive in the face of global uncertainties? The 10% tariff on UK goods entering the United States officially came into effect on Wednesday. While this rate is considerably lower than tariffs imposed on other countries, it is still expected to have a noticeable impact on the UK economy in the short term. Industries such as automotive and pharmaceuticals are likely to face the most significant effects. The UK's automotive industry, home to prominent brands like Jaguar Land Rover and Mini, is forecast to be particularly affected. Manufacturers may encounter increased costs due to the tariffs, forcing them to adjust production or seek alternative markets to mitigate the damage. Specifically, factories in Oxford, where Jaguar Land Rover and Mini vehicles are produced, could face production scale downs, threatening approximately 25,000 jobs. Moreover, pharmaceutical companies like AstraZeneca and GlaxoSmithKline, major exporters to the U.S., will also face challenges in maintaining profitability. Around 40% and 50% of their products, respectively, are exported to the U.S., and higher tariffs could reduce the competitiveness of these products in the American market. According to a recent financial report from the Bank of England, the UK's financial markets remain stable. British banks have also demonstrated a strong capacity to support households and businesses, should the economy face further difficulties in the future. However, financial experts advise against withdrawing investments in the face of short-term volatility, as stock markets tend to recover after brief recessions. While the trade war initiated by Trump has created difficulties for many countries, it could present an opportunity for the United Kingdom to attract foreign investment. The UK has seen a decline in foreign investment in recent years, primarily due to uncertainties surrounding the political and economic situation post-Brexit. However, the 10% tariff imposed by the US on UK goods may make Britain a more appealing option, especially compared to other nations within the European Union, where US tariffs are over 20%. Investors are likely to seek countries with stable and low tariff environments to maintain their competitiveness. With relatively low tariffs from the US and the UK achieving a certain level of political stability following the recent governmental power transition, the UK could attract more foreign investment. Prime Minister Rishi Sunak and other UK political leaders have emphasized the importance of re-establishing trade and political relations with the European Union to alleviate the challenges brought about by Brexit. The UK is seeking to strengthen ties with the EU, especially in the areas of economic and defense cooperation. This is evident through plans for a UK-EU trade conference, scheduled for May 19th, aimed at improving trade conditions and removing barriers to the exchange of goods and services. If the UK can reach agreements with the EU on trade facilitation measures, such as mutual recognition of qualifications and defense collaboration, this will be a crucial step in strengthening the UK's economic position in the future. Trade tensions between the United States and China are escalating significantly, with a series of countermeasures emerging from Beijing. The question now arises, what will China do next to navigate and potentially reshape the global trade landscape? During the early phase of the US-China trade war, 2018 to 2019, when the Trump administration imposed a 10% tariff on Chinese goods, Beijing expressed strong dissatisfaction. However, as the tariff rate rose to 34%, the language shifted to firm opposition. At the height of tensions, when the United States threatened an additional 50% tariff in response to China's retaliatory measures, the Chinese Ministry of Commerce escalated its tone, no longer limited to stating firm opposition. The ministry described the move as a mistake on top of a mistake, and even used terminology equivalent to extortion, a term rarely employed in official discourse. According to the Peterson Institute for International Economics, 2024, China has implemented a wide range of large-scale retaliatory measures. At the peak of the tensions, China imposed tariffs as high as 84% on a variety of U.S. imports, including energy products, agricultural goods, and consumer items. In addition, China introduced export restrictions on strategic minerals, among them rare earth elements, which are essential for both technological applications and national defense. A notable example is the TikTok negotiations. After the U.S. government requested that control of TikTok's American operations be transferred to domestic investors, China initially appeared to be in agreement. However, according to the New York Times, April 2025, as trade tensions escalated, Beijing unexpectedly withdrew from the arrangement, leading to a deadlock. According to the Sovereign Wealth Fund Institute, 2024, China continues to maintain a significant trade surplus and holds one of the world's largest sovereign wealth funds, valued at over 1.2 trillion US dollars. In response to the United States raising cumulative tariffs on Chinese goods to 100% within a few months, 2024 to 2025, the Chinese government introduced a direct support package aimed at stabilizing financial markets, as reported by Reuters. Specifically, the People's Bank of China, PBOC, injected credit into enterprises operating in sectors affected by the tariffs. State-owned funds purchased listed shares to curb the sharp decline in the stock market. As a result, China's financial market, which had experienced a steep drop in early April 2025, stabilized and showed modest recovery in the following sessions. China is actively engaging in international forums to promote its image as a stable economic partner that refrains from interfering in the internal affairs of other countries, while upholding the principles of equality, multipolarity, and mutually beneficial cooperation. According to the South China Morning Post, at the Munich Security Conference in February 2025, China's representatives delivered a 4-point message: ensure equal treatment among nations, adhere to international law, promote multilateralism, encourage openness, and the sharing of economic benefits. In addition, China is leveraging its stance of non-conditionality, not linking cooperation to human rights, environmental commitments, or institutional reforms, to appeal to developing countries. These nations often face large capital needs, but may be reluctant to accept pressure from Western powers. China is using soft power and its economic strengths to develop a global network of partners, with a strong emphasis on pragmatism and long-term commitment. However, developments in the South China Sea and the Taiwan issue may influence the level of trust China aims to foster on the world stage. U.S. imposes a 145% tariff on Chinese goods, shaking world's markets and revealing risky economic ambitions. The 145% tariff recently imposed by the United States on Chinese goods hasn't just rocked global markets, it's sparked big questions about Washington's new economic strategy. Is this truly just a tariff decision, or the opening move in a much larger economic showdown? This confirms total tariff rate on Chinese goods reaches 145%. The U.S. government has officially confirmed that the total tariff rate on certain imports from China has reached 145%, including a previously established 20% and a newly added 125%. According to a statement from the White House, this move is part of ongoing efforts to recalibrate the trade balance and address concerns surrounding industrial policy and economic security. Following the announcement, U.S. financial markets reacted noticeably. The Dow Jones Industrial Average fell by 3.4%. The S&P 500 declined by 4.2%, and the Nasdaq dropped 5%. These shifts reflect growing investor caution amid expectations of higher import costs, which could weigh on corporate earnings and dampen consumer outlook. Following a strong rally in early April, the U.S. stock market has experienced a downturn after news emerged that the U.S. government would impose a 145% import tariff on Chinese goods, specifically since April 2nd, when former President Donald Trump announced the tariff hike plan. The S&P 500 index has dropped approximately 6%, despite a session where it had gained over 9% shortly thereafter. In the trading session following the announcement of an additional 125% tariff, bringing the total tariff level to 145%, the Dow Jones Industrial Average fell by 1,700 points, around 4.14%. The Nasdaq declined by 5.75%, and the S&P 500 lost nearly 5%. Many experts believe that the high tariff levels have heightened concerns over import costs, directly impacting corporate profitability. Investor sentiment has also been affected by the lack of clarity surrounding trade policy direction, prompting more cautious behavior. The movement of capital away from equities towards safe haven assets, such as gold and bonds, highlights the increasingly defensive posture of the market. Bond market, according to former U.S. Treasury Secretary Janet Yellen, former President Donald Trump's decision to delay the imposition of tariffs on Chinese goods for 90 days reflects pressure from financial markets, particularly the U.S. government bond market. Following the announcement of the 145% tariff rate, the yield on 10-year U.S. Treasury bonds surpassed 4.4%, rising sharply from around 4.1% in early March. This surge in yields was largely driven by a wave of investor sell-offs, which caused a significant drop in bond prices, a signal of growing uncertainty surrounding traditional safe haven assets. This development is regarded as a warning sign for the U.S. administration, as a continued decline in bond prices could raise government borrowing costs and potentially impact the standing of the U.S. dollar in international markets. While the White House has stated that the temporary delay aligns with its original plan, many financial experts believe the market's strong reaction compelled the administration to postpone full implementation of the new tariff package in the short term in order to ease systemic pressure. Small and medium-sized enterprises. According to expert Zhongyuan Zoe Liu of the Council on Foreign Relations, CFR, the United States' decision to impose a total tariff of 145% on Chinese goods may have far-reaching effects on small and medium-sized enterprises, a sector that accounts for approximately 80% of China's export value and between 70 to 80% of employment in its manufacturing industry. These SMEs primarily operate in low-margin sectors, such as electronics, textiles, auto parts, and household appliances, and rely heavily on access to the U.S. market. The high tariff rate undermines the price competitiveness of Chinese goods, leading to canceled orders and reduced export volumes. According to data from China's Customs Authority, exports to the U.S. in the first quarter of 2025 declined by 8.6% compared to the same period last year, though marking the steepest drop since the COVID-19 pandemic. According to Zhongyuan Zoe Liu of the Council on Foreign Relations, CFR, the U.S. policy proposal known as the Mar-a-Lago Accord, named after former President Donald Trump's resort, could have concerning economic consequences if implemented. Under this framework, the United States seeks to simultaneously achieve three major objectives. 1. Systematically devalue the U.S. dollar in order to boost exports and enhance the competitiveness of American goods in global markets. 2. Maintain the U.S. dollar's global dominance as the primary reserve currency in the international financial system. 3. transition the U.S. from a trade deficit to a trade surplus economy, while also calling on allies to contribute more to regional security costs. However, LIU notes that the aim of devaluing the dollar to support exports, while preserving a strong dollar to safeguard its global position, presents a fundamental policy contradiction. Historical experience from the 1985 Plaza Accord shows that currency realignment can create short-term advantages, but often leads to financial instability. Moreover, the U.S. has consistently run trade deficits since the 1970s. In 2024 alone, the trade deficit stood at approximately $773 billion, according to the U.S. Bureau of Economic Analysis, BEA, reflecting the persistent nature of the imbalance. Despite previous policy efforts, if the Mar-a-Lago Accord is implemented without coordination from major economies such as China, Japan, or the European Union, all of which hold significant amounts of U.S. Treasury bonds, confidence in the U.S. dollar could be weakened, potentially leading to instability across the global financial system.